So were you investing in California and you said it no longer makes sense? Were you having cash flow or were you thinking more of just the appreciation or how were you what's your investment philosophy? And you just
Yeah, so that's a question investors always talk about, and I think one's investing philosophy should change and evolve as people age and perhaps go through different stages of life. So one size doesn't fit all, and so I think one has to adjust their investment approach as their life evolves, as their career evolves, and as their demands on their life change. So, investing in the Bay Area, it certainly wasn't a cash flow market. It was more an appreciation play where basically, if I felt I could buy a house and put 25% down and the rent would cover all the operating expenses like property taxes, insurance, maintenance, repairs, and my loan payment.
Mhm.
If I felt the rent would cover all those expenses, let's call it break even,
Right?
so not much cash flow break even, I was okay with that because at that point I was 25, 30 years old. And so my time horizon was way down the road. And so I was okay with not getting much cash flow. Now, to be clear, I still wanted the properties to be self supporting. And by that, what I mean is the rent plus maybe a little buffer is enough to pay all your expenses and debt service. So I don't believe in negative cash flow. I don't believe in feeding a property to own it. The property should be self sufficient once you buy it and invest the capital. So that was my approach. By the time I got to Austin, it had started to be an appreciation market. Did get some cash flow, but again, the main play was appreciation. And I would submit early in one's working career, as they move up what's called a corporate ladder or establish a professional practice, they're probably making pretty good money. And I would say most times the income, that W 2 income, the 9 to 5 income, should be enough to support one's lifestyle. So a highly paid corporate person at the age of 35 probably doesn't really need cash flow. I think they're looking at what's it going to be like at 50 or 55, and can I be work optional? So I think initial focus on that capital growth, increasing net worth. And then as you get older, maybe the scales tip more towards cash flow as you want to get work optional or not work 60 hours a week, maybe only work 30 hours a week. You need more cash flow when you make that transition.
I like the words work optional, and I also like that you want to take into consideration when you want that to be real for you. Whether you're 35 and you're thinking 55 or you're 35 and you're thinking 40, 30 and thinking 35, you're gonna have your kids, whatever however you're thinking about that, it is a you have to think about it and plan that into your investing strategy. If your whole investment strategy is your 401k, it's not and you're 35, it's not gonna do anything for you until you're at least 59 and a half, and that's the rule today. Who knows when that rule is gonna change? So it really is a thought process on when you want to have work your 9 to 5 or 7 to 7, whatever it is, as an option and not a have to. I'm
Yes.
about making it an option as soon as you can. That's how I think about it. And keep doing it if you love it, because you love it so much more if you know you don't have to do it.
So I'm 70 years old, okay? And I've been in the real estate business 45 years. I'm set financially. I'm fine. I'm not a mega wealthy person, but I'm secure. I'm financially free. I still do this because I enjoy it, right? And I think people have a need to be productive.
Yes.
I love playing golf, but I can't play golf 7 days a week. I need to be productive. And if you can find a way to be productive and be compensated so it adds to the totality of your life, that's a win win. And people can benefit from our expertise to hopefully make their lives a little better, a little easier, a little less stressful. And of course, money's a big part of that and being financially secure. one of my favorite sayings is having to work is much different than wanting to work. And that's basically paraphrasing what you said. So it's a big distinction. If you get up and you want to do it, it doesn't seem like work. It's more fun and there's a little more joy to it for
Yeah.
sure.
Even the days you don't wanna do it, you just know that, yeah, it's a thing, and I ultimately, this is something that is serving me, not just financially, but serving your soul and serving your whole being, and working for money sucks that out of it did for me, sucked it out of me as far as, anyway. And we talked about cash flow versus appreciation. Your dad talked to you about paying yourself first, and it sounds like what you did is paid yourself first and then invested that money that was working for you into something that could work even more for you, and that's the real estate. I'm gonna change I was gonna ask one question, but I'm gonna ask a different question. Should people look at realtors and brokers for helping them find investment properties compared to helping them find their property they're gonna live in? So I think
Yeah.
people
So
think of those the same.
they're not necessarily the same. And it's just like in the medical field, if you have a particular condition, a particular need, you're going to go to a specialist who that's what he or she does. And it's not much different in real estate. The way I would also say it is the realtor who is selling the $2 million luxury home in the hills is not the same realtor that's going to find you your starter home down in the flats, let's say.
Yeah,
And so similarly, there are brokers, agents who do understand investment real estate and work with investors. And so for folks that want to start investing, try to search out, realtor specialize in the type property you may want to acquire. So for example, within anyone's community, there are going to be neighborhoods where there are starter homes, perhaps a fair number of rental occupied properties. And so that would probably be a good area to look to buy a rental. The prices are a little more affordable. The rents are probably pretty good. So you'd want to work with the broker or agent who specializes in that neighborhood. Just as the same if you wanted to buy 2 million up in the hills, you'd find that realtor that really knows that market and you work with them. So that's how I'd go about it.
got it, got it. So I also looked at your website. I know you guys at Spark Investment Group look at properties that are under 100 units. So were you managing your own properties when you were doing the single families, or how did that work for you?
Yes. So the ones in the Bay Area, I self managed.
Okay.
And of course, I was in real estate. So I was out running around. It wasn't like I was tied to my desk and I had 3 meetings that I had to be to like a typical corporate employee. So local properties I managed, but the ones I bought in Austin, I hired property managers to do it. And I would just say to your audience, having a good property manager is really key to the success of your rental portfolio. So, to some degree, it's trial and error finding the right one, but just understand property management is a key factor to making this all work.
It's almost like one of the first things you should do before you even buy something. You want to know the managers. What I found out is that when I had a good property manager, I could ask them about a house I was thinking about buying, and they're like, "Yeah, no, don't buy that. We don't want to manage it. If they don't want to manage it, you don't want to own it." So
uh, Great point.
it's like you don't go to a market and buy a property and then try to set up the team around it. You want to set up that team first because that team's going to help you be successful and buy that property that's gonna work for you. That's
Correct.
so key. I know so many people that go and they look at a town and say, "That town's really growing," any place in Texas right now, "It's really growing, and I can go buy a house there." Okay, great. Yeah, you can. And then what? That
And then what? So putting together your team. So it's finding the right broker, finding a property manager, and the property manager should have vendor references in
yeah,
terms of fixing the property up and all that. And so you form that team, and you're exactly right. A good property manager will know his or her market. So if you say, hey, I'm looking at a house in the Sans Souci neighborhood, they'll know what the rent is even without seeing the house. So that local knowledge about the rental rates and so forth is really critical.
Very much, very much. So you switched, it sounds like, or do you still self-manage anything, or you moved off
Uh,
to helping other people invest passively?
I was a little slow on the uptake, and of course, some of that is ego. We always think no one can do it better than me or
Been
you.
there. Yep.
Yeah, so no, I no longer manage any of my property. So most of my assets are now in the Greenville, South Carolina area, and all own single family duplexes, 2 to 4 units individually. Those are with the property manager. And then with the multifamily properties, I have a property manager. And on the larger multifamily, the property manager and I are partners. And as I switched over, it was just kind of like, I should have done this 5 years ago. It's invariably, I'd be headed out of town on vacation, headed to the airport, headed on a road trip, and my tenant would call. The hot water heater went out, and it's no big deal. You get on the phone, you call your plumber, but it's just disruptive. So if I had to do it again, I would have turned it over to a property manager sooner. And certainly there's a cost, but your time is of value. I figure my time's worth $100 an hour minimum. And so the cost of the property management, if it even saves you an hour or two a month, it's still valuable. So I should have made that transition sooner. I'm much happier now that I have. And my partner at Spark on the multifamily, I find the properties, I negotiate it, I talk with the investors. He handles the day to day operation, and I'm totally fine with that. That's not my jam. That's not what I really like to do, but he loves to do it. So you partner with people who have strengths that are different than you and let them excel and shine in their areas. And that frees you up to really do what you like to do.
Perfect, perfect,
Yeah.
perfect. Yeah, I would have done it a lot sooner too. It's like, yeah, and you just when people start talking about it, it's like, "But that's cost. It's gonna add to the cost of the thing." It does, and you put that if the house doesn't at least break even with you having management, then it's not a house. You don't that's not for you. That's the bottom line on that.
Precisely.
We don't wanna be feeding things, at least have it break even. Aim for the fences or base hits in your property buying.
Yeah, for me, I'm old school conservative investor, so I don't swing for the fences. I don't try to hit grand slams. I believe real estate is a slow and steady, long term thing. So I aim to hit line drive base hits. And by that, what I want to do is I want to buy good properties in good locations and then just basically let time, population growth, and inflation win the day for me. And so we were talking earlier about somebody 35 maybe wanted to be work optional at 40. I think it's totally doable with a consistent investing strategy. 5 years might be a little quick, but I think
Sure, yes.
certainly within 5 to 10, you can make it happen. You just have to be disciplined and you don't have to hit the home run. Just make good deals, buy good properties. You're going to win. The price of housing from time to time may dip a little bit, but the long term trend is up. I've been at it almost 50 years. And I guess I would ask, does anybody think the cost of housing or the cost of rent is going to be less 5 to 10 years from now than it is today? I don't see any way that anybody could make that argument. The cost and value of housing will continue to increase long term. So I'm bullish on real estate investment.
Yeah. The only thing with it is that can happen is like a 2008, and if you're in it and all of a sudden you need to sell and you can't, then you're just there. Same thing with the stock market though. Everybody says the same thing. The stock market over time is going up. Yes, there are dips, but if that dip happens when you need to get out of it, you got a problem. So I'm not saying to not do either, but you could do both, and because they usually do not fall at the same time. They're not that correlated, even though sometimes it looks like it. And you can just be diversified, well diversified, and not just diversified in your paper stuff, but you want some hard assets out there also. That's my
Yeah,
You know, like the rest of them.
100%. If you look into the whole world financial structure, it's basically comes down to the full faith and credit of the United States government. Everything comes that the US government can pay its bills. And so, in a sometimes uncertain world, to me, diversification is a way to minimize risk. So for me, I'm a real estate guy. That's what I do. And I would say my portfolio, maybe I've got about 65% in real estate and 35% in stocks and mutual funds. I believe in both. I think there's a need for both. And generally, coming from the Bay Area, many of my investors are tech people. They're heavily in stock. And so I just try to talk to them about how about a little diversification? And they understand the argument, and how one allocates their portfolio is up to them. But I'm a strong believer in diversification. The other thing I would say is don't invest in anything you don't understand.
Mhm.
And I'm a relatively smart guy, but for the life of me, I can't get Bitcoin. So I don't understand it. Sorry, I'm a dummy. So I'm not investing in Bitcoin. Somebody else can do it, but I'm only going to invest in stuff that I know. And I think generally that's good advice. If you don't understand the investment, I would say probably it's a no go.
And it's not because 'cause you're dumb, it's just sometimes you just can't things just don't click, and a lot of times it doesn't click because it's not real. So, I've been scammed
Leave it
before.
at that.
I'm just gonna put that out there. I've been
Okay.
scammed before because something didn't make sense. I was like, "Maybe I'm just not thinking well."
Yeah.
Yeah, no. That's really, really good stuff. You moved from California. Why did you move to Greenville just because you were retiring and decreased cost, or what was it about? You wanted to do more investing over there, so you thought you'd live there? What made you do that move after living in California for so long?
Yeah, so basically I spent 50 of my 70 years in the San Francisco Bay Area. I did have 10 years in Queens, New York, which I really loved and valued and was happy I had that experience. My life partner, Laura, had a big Silicon Valley career working for Intel, Visa, and Intuit. And the Bay Area, while being a fabulous place to live, awfully expensive, awfully hectic, 24/7, go, go, go. And we were just ready for something different. And we traveled around the country, visited places in Arizona and Texas, and we got on the Carolinas, thought we might move to Charlotte, which is about 90 miles away, and ended up settling on Greenville. So the move was more about a lifestyle decision.
Yeah.
And then, of course, when I got here, I go, man, everything looks cheap coming from the Bay Area. Yeah, these houses are 125,000. So I just continued investing. And then in 2020, really when COVID hit, had a phone call with a local investor friend of mine that I had met at the gym when I first moved here. And he turned me on to multifamily, and that's when I made the transition from primarily single family into multifamily, and now I've been doing that for about 4.5 years. So more a lifestyle decision. Greenville's proved to be an excellent market. We're between Charlotte and Atlanta on the I-85 corridor, and I think most investors understand if you invest along interstate corridors, it's probably gonna be good. When I started investing in Austin, San Antonio is about 50 miles south of Austin on I-35. When I started investing there, it was basically farm country between Austin and San Antonio. It's wall to wall people now. It's been one of the hottest investment markets. So along a corridor with trying to bring back manufacturing and onsourcing, it makes sense. So it's a good market. So it's just natural that I continue doing it. And now that I moved into the multifamily and have some partners that kind of handle the day to day, it's a great fit for me.
You guys are doing syndications now, and you've pretty niched down to under 100 units. Why that? Now, why not the big?
Yeah. So many syndicators, many investors will say bigger is better, buy 200 units, 300 units, it's better. And I'm not saying that is wrong. We like the smaller assets for a couple reasons. My partner Brian's property management business is more a residential property management business where typically 100 units or more, you have on-site leasing and maintenance and your employees, where with single family, you have an office and you manage these properties. So he's more set up as a single family. The other thing is often when we buy these properties, they've maybe been neglected or operated by long-term owners who bought the property for next to nothing 25 years ago. Maybe there's deferred maintenance, need repairs. So for us, we like getting the smaller asset because we can go in and in a matter of 12 to 18 months turn that property around. And now the property is performing, it's on autopilot, we've increased the income, the operation is smooth. Where if you go into a 300 unit property, it could very well take you 3 years to turn that one around. So we actually like being able to get in, turn a property around, and then go to the next property. The other thing I would say is most of the larger properties are owned by investors who own thousands of units.
Uh-huh.
They're very wealthy, they're very sophisticated, where oftentimes the smaller properties are kind of mom and pop operations. And so there's a little less competition because you're not competing against hedge funds or BlackRock or anything like that. So we really like this smaller niche and it's what we do and it works for us and our investors.
Gotcha.
Yeah.
Any thoughts of expanding outside of Greenville, or are you looking at that at all? Or it sounds like you decided on how you're going to do that based on your team and what your partner had as far as management. Are you looking to do anything anywhere else?
Yeah, that's a great question, and the answer is yes, because the Carolinas as a whole is great. There's great markets in North Carolina. In South Carolina, it tends to be either Greenville or the Charleston MSA is booming. Boeing, Volvo, Mercedes-Benz is down there. Where in Greenville, we got BMW and Michelin. And of course, the Carolina market, Charlotte, Raleigh, Durham, Winston-Salem are all great. It gets back to your comments about having a team in place.
Yeah.
And my my dilemma is I don't want to go into a new market without having a team and buy a 75 unit property because if I pick the wrong team, there may be trouble and now I got a big problem on my hands. On the other hand, you might say go smaller. And then it's kind of like, well, how much time do I want to spend dealing with the 16 unit property? Is it worth my while? So at some point, I would hope to expand. I am a big, firm believer in local knowledge about real estate, boots on the ground. I think it's important to keep your eyes on your assets. You got to know what's going on in the neighborhoods. So if I could find one or two partners in some of these other markets that I trust,
Mhm.
then yes, I'd be more likely to expand because Greenville is about 500,000 people, and the 9 county region called the Upstate's about 1 million. So basically, the entire upstate is like the size of a average size city. Charlotte's 1 million, San Francisco's 1 million. So it's a relative small market. It's not like Dallas, Fort Worth, or anything. So I would like to expand, but I got to find the team, and I have to do it in the right way.
So what I'm hearing is there's a lot of consideration into expanding. Is you really have to think about that. And again, guys, the team is the most important. And when Arn was talking about eyes on a property, they can be your eyes or there can be the eyes of someone you really trust, making sure that things are going well. So that team is everything, especially if you
Yes.
don't want to be on a plane every other week, every 2 weeks, every going out to make sure everything's okay, and or getting phone calls when you're on your way to your airport or to your vacation or to work and have
Yes.
that in your head.
And I know you work with a lot of investors and try to mentor and coach them to making good investment decisions. And I think one of the things I would suggest is if you are going to invest in a syndication or a passive investment opportunity, work with a team, work with a sponsor that has a clearly defined niche.
Right.
And by niche, a particular kind of property in a particular market. So, for example, there may be some great operators who do the downtown Dallas Fort Worth luxury Class A apartments, and they know that niche, they do it great. If, however, they were going to bring you a value add 1970s deal in Charlotte, and it was their first time in the Charlotte market, and it's a total different doing a 1970s workforce value add deal is much different than a luxury Class A deal. And then I would pause a little bit because, okay, I know the operator knows what they're doing in Dallas with these new buildings, but do they have their team yet together to really do a renovation in Charlotte? So I'd recommend look for operators that have a track record with a particular type of property in a particular market. They will have already worked out the kinks on their first deal and their second deal. And now, if you come in on their fifth deal, you have a better chance of picking an operator that really has the things dialed in and it's going to run smoothly.
Yeah, I 100% agree. You gotta know where they've been, and if there's a big old switch happening, you may not wanna be in on that first switch. Not mean doesn't mean it's not gonna do well, but you have a more of a chance of losing. Speaking of losing, Arn, have all of your real estate deals gone well? Have they all been perfect and things just are
Nope. I'd like to say yes, but no. So, one, any investment involves some risk. Two, Murphy's Law strikes and things outside your control can happen that will impact the performance of your investment. So, over my 45-year career, I've made a few mistakes. The one thing I tell investors is mistakes are going to are going to happen, but you want to make sure they're not mortal wounds,
right.
right? There've been times I've got into deals and I decided, no, it's not going to work. And sometimes I'll walk away and I'll lose $10,000. Okay. I don't want to lose $10,000, but it's not going to kill me. It's not going to destroy my financial well-being by accepting the loss and moving on. And sometimes see investors trying to resuscitate this failing deal, and it's just throwing good money after bad. So I have made a few mistakes. They've been minimal. Hopefully, I've learned from them and I try to get better. The other thing I would say for me, when I ask people to trust their hard earned capital and invest with me, I feel a very high level of responsibility and duty to protect their money. So I would say on my own investing, I may be a little more aggressive, a little more opportunistic because it's my capital. If I make a mistake, it's my loss. I'm an adult. I deal with it.
Yeah.
But when I'm
Yeah.
dealing with other people's money, there's an extra degree of caution there because there's that responsibility. And so I'm probably a little more conservative in my larger investments than I am in some of my smaller ones.
I agree.